Everyone wants to take their business, their skills, to the next level. Small and mid-sized business owners have exceptional insight into how to do this. They endure and thrive because they find ways to overcome the challenges that come their way, and they can teach us valuable lessons to apply to our own companies and lives. Stephen Nooner, founder and owner of Alkali, a company with a unique process that helps businesses more effectively buy and manage their insurance programs. And Bob Gibbons, builder of Riata Commercial Realty, a real estate advisor and tenant advocate, are two prominent Metroplex businessmen who, along with their weekly guests, will ask their and your probing questions, finding impactful solutions that will help you reach for the next level. Here are your hosts, Stephen Nooner and Bob Gibbons.
Welcome to the Next Level, conversations that propel business. This is Bob Gibbons.
And I'm your host, Stephen Nooner. And I'm excited to introduce a new friend of mine. Wolf Hanschen is here with us. He's the co-founder of Peregrine Energy Partners, a company that partners with various capital sources, including private equity firms, family offices, and high net worth individuals in sourcing institutional quality energy assets for both cash and 1031 exchange investments. So we're going to learn what that actually means.
Read that so well.
Yeah, thank you. To learn more, please visit peregrinelp.com. That's peregrinelp.com.
Or peregrine1031.com. We got two of them.
Oh,
Yeah.
okay.
So
You did your homework.
I did. Welcome to the show.
Thank you guys for having me. I appreciate
Welcome.
it. Absolutely. Happy to be here.
So we always like to start off with what we call wisdom of others. And today we're going to use the quote that you actually provided from somebody named Danielle Vere. I'm not sure how to say that. Volare. Anyway, she said, diplomacy is the art of letting someone else have your way. Why do you like that?
Well, I heard that maybe 5 or 10 years ago, and I realized both in business and in social settings, you saw so many people out there trying to kind of will their way onto others, and it wasn't the path of least resistance by any means. And so I saw this and I realized that, a simpler quote is you can get more flies with honey, and this kind of just elaborates on that, saying, if you can get someone to think your way and look your way rather than just push your thoughts onto them, there's a greater chance that they're going to follow you or side alongside you. And so that's always rang true with me, again, both in business and in social settings.
This has really impacted me because I read this quote and I got to thinking, I realized that Bob does this to me every single day.
We're going to have to take that off air. But it's the whole idea of leadership, right?
Sure.
Better to lead people, get them to follow by demonstrating what you want instead of just badgering them, telling them, do this, do that, like, I have to do with Stephen.
Absolutely.
So, okay. Makes sense. So tell us, give us the nutshell. What does Peregrine do?
Sure. So Peregrine lives in what they call the mineral and royalty space of the oil and gas sector. And energy, especially here in Texas, is very prevalent. A lot of people own royalties or involved in the oil and gas sector in some way. And since 2003, that's really the only world I've known is the producing mineral side of it. And essentially, a oil and gas mineral is a lucky landowner. You guys remember the Beverly Hillbillies, the old story about the family that happened to have oil and gas on their property. Even though it's kind of a hokey example, it really embodies a royalty owner, and that this was just a lucky family that was born on the right piece of property. They hightailed it out to Beverly Hills, had nothing to do with the day-to-day exploration of oil and gas, the drilling, any of that, but because that was their land, they got a deposit in their check or deposit in their bank every month, and that was a royalty. It was a percentage of the cash flow from their land. So it's not dissimilar from real estate, where firms like Exxon and Devon and these companies, these big operators, there are tenants. Mm-hmm. In other words, they come on our property, they drill for oil and gas, they take all the risks, they put up all the expense, but because it's my property they're on, I get a percentage of everything they find, and that's a royalty. And so at Peregrine, we kind of focus on creating efficiencies in a somewhat inefficient market. And by that I mean connecting either those that want to sell or divest a portion of their oil and gas minerals for cash, or more likely than not, we see a lot of clients who want to own said royalties or minerals, but really don't have any idea how to go about finding or sourcing those properties. And so that's where Peregrine comes in the middle, is connecting buyers and sellers.
Why is that? Like, what, I mean, why do you think that like nobody really knows? Yeah, I mean, the oil and gas is such a huge ongoing investment that generates tons of return for gazillion investors. But why do you think that your space is still pretty well unknown?
That's a good question, and a lot of the times people say, why don't you try to streamline it and make it more efficient and put things in place like there has been on real estate that allows just the average investor, the average client to go in and dissect it. And a lot of it comes down to the fact that oil and gas mineral interest is what they call an undivided interest. So unlike a rental house, for example, where you typically have one, maybe two owners that own it jointly or own it, usually just a sole proprietor owns it, an oil and gas interest right here, for example, in the Barnett Shale in Fort Worth, you may have 100 different people all owning a small sliver of the same property. And so it's very hard to get one's arms wrapped around that from a title standpoint, from an ownership standpoint. And if you wanted to acquire it, you would literally have to make 100 separate acquisitions. So it's very fragmented. It's very, that makes it inefficient in that there's so many owners. It's undivided, and it's not tangible. Even though it's below the ground and it's a real property, it's not like a building or a house where I can go to it, I can see it, I can touch it. So again, it's tough for people to get their arms around.
And it's the tangibility of it that you talk about is really important because, you're right. Whenever somebody has the surface rights, whenever they own real estate fee simple, they own all the real estate, not only on the surface, but below the surface. But then they can split those out and they can sell the royalties for the minerals separately if they want to. And so then all of a sudden they own the surface rights, but that means they can build a house, a building, or whatever on it, but they don't have any rights to what's below it. But
correct,
you may, or your clients may.
And we have to explain that often. We'll source a mineral property somewhere in the United States. We buy everywhere from Alaska to Pennsylvania and down to the Gulf of Mexico, and we'll find a property, a mineral right property, for a client. And they'll say, "Well, can I go there? Can I camp there? Can I hunt there?" And we have to explain the difference between surface rights, which you and I know is real estate or land, and mineral rights. And back in 1865, the U.S. government bifurcated or separated and said, you can own the ranch, but if you'd like, you can sell Steve's the mineral rights, and then it becomes separate pieces of property. And so we have to do the explaining that no, you can't go camping or go hunting on these properties because we don't own the real estate. We just own what's below the ground.
And just because you own the minerals doesn't mean you even have any specific right to the surface to get to the minerals.
So in that case, the minerals supersede the surface rights.
Okay.
So if you own the farm, let's say, but I own the mineral rights, you have to allow me access to get at my minerals, reasonable access. I can't come drill a well through the middle of your backyard and destroy your house. But if it's within 200 feet of any structure, I have the right to come on and explore for oil and gas, again, within reason.
But that changed a lot with horizontal drilling, didn't it?
It did. Horizontal drilling actually made it much easier to access oil and gas reserves without having to drill multiple wells. In fact, a single horizontal well can now access about the same oil and gas reserves that it took 9 existing old vertical wells. So from an environmental standpoint, from a surface disturbance standpoint, it's actually much better because I have now one hole going into the ground that covers the same amount of footprint, if you will, that it used to take 9 surface areas, 9 separate wells to get at.
So like, for example, my in-laws own 10 acres and in the Barnett Shale. And so whenever whoever came along to develop those and drill that, they were part of a larger pool of owners. So they were 10 acres out of like 240 acres. And then the agreement was that the wells would never be on their property. The wells were going to be somewhere else. And I don't know if that's valid or not, but that was what they were told. And so they have a mineral right, which is, 10 divided by 240 of whatever those rights are. But you're right, there's a whole lot of other people involved. And then we've sold the house, the 10 acres now,
kept the
but
minerals.
They still own the minerals.
Sure, and so you can see how things get split up and mixed around, and let's say they, left you half that and a sibling half. Well, now you've parceled out even more, and then you leave it to your kids, and that's what's happened over time is that someone started out with 100% of the minerals, but 5 generations later, their great-great-grandkids own, 0.01% or 0.001, so it's, again, very fragmented.
So who comes to you, and what's the problem that they have? I mean, how do they know that, hey, I need to talk to Peregrine?
So on two sides of the equation. One would be like your folks that say, hey, we have this great income from my mineral assets. I'm getting a royalty check, but gosh, I'd love, $500,000 tomorrow to retire or buy a house or pay for a wedding, or there's a million different reasons why someone might want to divest, estate planning, tax planning, all sorts of things that they may want to sell their royalties for. And that's kind of where we come in, as we go and then find buyers on the other side of the equation, those that weren't lucky enough to own 10 acres in the Barnett. And we'll go and basically connect buyer and seller, saying, hey, these people would like to divest either a portion or all of their minerals, cash out, if you will. These people have cash, but they would love a nice 20, 30, 40-year monthly income stream.
So what is is there a going rate, so to speak? I mean, what's the return on investment somebody should expect if they buy a fragmented oil interest?
And that's a great question. It's all over the board. And that's where, unlike real estate, where especially on the residential side, like we talked about, there's comps. You kind of know what you should pay per square foot based on the area, based on the building, et cetera. We see people paying, $1 for a property, and the very next property next door, the same attributes, they're paying $10 for someone else. So there's no,
no like cap rate or whatever. I mean,
not really. I mean, traditionally, what we try to do is we go and buy assets that will generate somewhere around a 9 to 11% cap rate to clients. And again, a lot of those are 1031 clients that are coming out of real estate that say, hey, I've sold my building, my rental property, my land for a great appreciated value, but now I face this huge capital gains tax, and either have to pay the tax, buy another similar property in real estate, or I can go into something like oil and gas, which the problem with real estate is if you sell at a high, that means you're probably going to buy at a high too, unless you can just find a screaming deal. So we've for the last 18 months seen a big influx of real estate clients.
So so back to the thing about determining what the value is. I mean, is there not any kind of, oil and gas is not a new business anywhere. So is there not some sort of marketplace where I can go on and say, hey, I've got this, thing that's generating $100,000 a year in income.
Sure.
And it's not sort of on a bid. On an exchange somewhere. Is there not anything like that?
They have a few auction houses. EnergyNet.com is one. So they've tried to put some semblance of kind of technology and streamlining it in there. But, for the doctor or real estate investor out in California, for him to get on there and know what a Barnett Shale is, or know, 10 acres better than 20, et cetera. So, yes, there's been some attempts there, but it's still
very inefficient,
very fragmented. Yeah, people don't know what's what a lot of the times, and that's where Peregrine comes in, is kind of connecting the dots.
So you act as a broker, is that right?
Kind of a high-end broker, but we also do things like title work, engineering work, because again, that the guy from Wall Street or the retired couple in Florida, they don't know the difference between the Barnett Shale and the North Dakota, the Bakken Shale, and these things. So we kind of come in and lay everything out and simplify the process for them.
So it's not just income. You're not just buying $100 of income. It'll vary from one shale.
Just like real estate.
Okay.
Buying in downtown Manhattan's a lot different than buying in Topeka, Kansas.
Wolf wants to build a lifestyle company for not just the owners, but the employees too. That sounds great, but how does that work? Stick around.
And now, Confessions of a Recovering Landlord.
This is Bob Gibbons with Riata Commercial Realty, and I am your recovering landlord. After 20 years as a landlord, I now use that experience only for the benefit of companies that lease or buy office buildings and warehouses. Today's confession: knowledge is power. We all negotiate from a position of power and strength, or at least we want to. In any negotiation, the party with the most knowledge probably has the upper hand, and landlords count on this being the case whenever you're negotiating a lease, because most landlords are professional real estate investors and they hire professional leasing agents and property managers. Landlords are in the market every day negotiating leases, while tenants probably only negotiate 1, maybe 2 leases every few years. So tenants feel outgunned. Don't let landlords have all the power. As a former landlord for 20 years, I understand how landlords think and what motivates them, so let me put that knowledge and experience to work on your side of the negotiation. To learn more, contact me at TexasTenantRep.com. Again, that's TexasTenantRep.com.
Have you started making plans to take your business to the next level in 2016? Hi, I'm Stephen Nooner, founder and CEO of Alkali. We have a trademark process called the Empowered Advantage that enables CEOs, business owners, and entrepreneurs to more effectively buy and manage their insurance. Before sitting down to make your plans for the new year, here are just a few things to consider. Would you say that you have an actual insurance strategy, one that you can articulate, or have you just purchased a policy here and there over the years? If you have an insurance strategy, was it discussed under the pressure of a renewal deadline or considered earlier in the year to avoid fire drill decision making? If your answer was no to either of these questions, then you may not have the right partner on your team. Visit alkaliservices.com to contact us and take the next step to a bigger and better future.
I'm Flip Crofcadero, co-founder of the Infinite Agency, and we are inspiring purpose for our brands and for our people. After speaking with Bob and Steven, I'm wondering if their purpose is something else other than this show.
Welcome back. We're here with our special guest, Wolf Hanschen, Peregrine Energy Partners. Please visit Peregrine, Peregrine, 1031.com.
Okay, so you've touched on this a little bit, but help me be a little bit more clear. Who exactly is your ideal client? And also, how do you differentiate your company from all the other people in the oil and gas industry?
Sure. Great question. So I think there's two sides of the equation. One side of the equation on the clients is those that already own producing oil and gas royalties, that love the income but want to cash out at least a portion of it, or all of it sometimes for whatever reason. Again, we have people call that are have 3 kids in college and they need extra cash. They're trying to pay off their house. They want to retire early. There's a myriad of reasons. A lot of estate and tax planning. They may own a bunch of oil and gas royalties and nothing else, so they want to diversify into things like real estate, etc. And then on the flip side of that coin is the opposite of that, someone that loves the idea of owning a non-correlated asset class like oil and gas. They want that natural hedge against inflation where they get a check every month that goes up with the price of gas, with their electricity bill, etc. But they have no way to access it other than knocking on doors in Tarrant County, which is not very efficient. So those are really the two types of people we help, either those that own oil and gas mineral rights, royalties all around the country that are looking for divestment options, or more likely than not, a lot of the times what we do is find clients or clients find us that would love to own a piece of that asset class but just don't know anything about it, and trust our experience, again, on the title of the engineering side, knowing a good property from a bad property, etc., for us to go out there and source what they're looking for, either on the cash or 1031 side.
And is there like a minimum transaction size they need to be focused on?
Normally, we don't do much under $100,000.
Okay.
We try to buy our clients diversity, meaning both operational and geographic. We don't want them owning one oil or gas well in one state and one county with one operator. That's like picking one stock. So we try to buy them a mini mutual fund of 10, 20, 30 different producing wells in different states under different operators, and that way they've mitigated that operational and diversity risk across different properties. And so less than $100,000, it's tough to do that.
Do you ever have investor groups that go together and come to you with $100,000?
Sure. We work with LLCs and LPs that'll kind of circle up some money and try to get together. Again, it's just like real estate. You can't. There's not many houses. Let's say, I'm sure that you can buy some real fixer-uppers for less than that, but there's kind of a critical entry point where you need to be to enter the market, and that tends to be the same for oil and gas.
Yeah.
Okay.
So I used this on the hook, but one of the things I thought was interesting is your vision for the company, and that you want to create a lifestyle business, not just for the owners, but for the employees. So I hear that and I think, okay, that sounds great, but how do you maintain forward progress if everyone's in lifestyle mode?
Sure, and I think that's a balance that we certainly struggled with, because when we opened the doors in 2014, I had spent 10 years at a similar company, but much bigger, much more corporate, and I had fun for the first 5, 6, 7 years. The last 3, not so much. And that's what I said to my partner the very first day. I said, as soon as this isn't fun, I'm out. I can earn a living somewhere else, but I've only got X number of years left on this planet, and I don't want to go to work every day at a place I don't enjoy. And so part of what we've done these last 3 years is really try to find that balance of work and life, both for the partners. There's 3 partners, and then we have anywhere from 3 to 4 employees and 4 to 5 contractors at each time. And how do we find that balance of getting work done, meeting the needs of our clients, both on the buy and sell side, but also making sure that everyone's having a good time. And I know that's kind of cliche at a work, to have a good time or what have you. But
we have a lot of fun.
I mean, if you're not having fun when you come into the office, then what's the point? I mean, anyone can sit there and stamp out widgets or whatever you make or produce or sell, but if you don't leave with a smile at the end of your day, I don't know, it never seemed worth it to us. So there's no silver bullet to answer your question about how we do it.
Yeah.
I think making sure everyone's voice is heard. I read somewhere that, if you discount your employees and you don't make sure their voices are heard and you don't make sure they're recognized, they turn into machines, and machines don't care. And you want people that care and share in your vision, because when they have buy-in, leading them becomes so much easier. And when you listen to them and you care about them, and I think that's the challenge, especially for entrepreneurs, because we're go, meet the numbers, grow, accelerate, etc. But you also have to look at the human aspect of it, and people make up these companies, and when they're cared for and they're heard and their thoughts and voices are considered, maybe not taken every time, but certainly considered, you see a change in them, and you see them going from someone that just comes in and punches the clock to someone that actually buys into the vision.
And that makes a huge difference in the business. I mean, we were talking this morning, my wife and I were just that, a great team member is so much more valuable than just someone that's kind of mediocrely engaged. I mean, if someone's really, really engaged. It sounds so weird, and we've not done everything right, and we've taken probably people that are great and engaged and probably took them into mediocre because we probably didn't do a good job, and then we've probably done it right a few times too, and it makes a huge difference.
Sure.
Yeah, and in fact, I went to an event that the Plano Chamber of Commerce put on yesterday morning, in fact, and they talked about millennials in particular, but I'm like, I don't want to hear any more about all these differences in generations, but what they were saying was that engagement in the workforce, regardless of generation, regardless of age, is only at around 60%. And now how they measure that, I don't know. I don't really care. But if people are not engaged in their job, and they're those machines that you talked about, Wolf, I mean, how that 40% of our population is dreading going to the work.
The way they measured that, there's an algorithm. They just posted stuff and saw how many people responded in the middle of the day on their Facebook accounts. And they're like, these people are not engaged.
That would be a good way. Well, Wolf, you've only been had Peregrine since 2014, but looking over that time frame, give us one of the highs, one of the things that you're real excited about that has happened.
I think one of the highs has kind of stemmed from the early fears that we talked about, and that was we really didn't have a track record. We didn't have a name for ourselves. I'd been in the industry for about 10 years, but within months we were sitting across the table from groups like Apollo Energy, hundreds of billions of dollars, private equity group, and these large family offices, and it was intimidating at first, but we started to get some traction. We got some business done. I said, David can play with Goliath in some of these scenarios. And I think that's some of the biggest wins was, I remember working from Starbucks for the first few months. We didn't have enough money for an office. And, we'd sit there and mooch off their Wi-Fi and see how many free refills we could get.
It's America's conference room. What are you talking about? They want it that way.
And we'd be on the phone with these big private equity groups, and there's a little bit of fake it till you make it, but it was nice kind of seeing them and regard us as a true entity, as someone that could add value to the space, even though we were small, even though we didn't have a track record. And 3 years later, thank goodness we're out of Starbucks. We're actually in an office and all that good stuff. But I think those were some of the early days when you're bootstrapping it and you have those even little wins. It adds up to a big morale booster, not just for the partners but for the employees too.
Well, let's turn the table a little bit. I mean, surely there had to have been some tough moments. Pick out a biggest low.
So I think, this year we've actually done less transactions than we did the first 2 years, which is surprising. And I think, one of the things we did, as cliche as it sounds, is take our foot off the gas a little bit. We had some early successes, and learning that success doesn't beget success. And we kind of started coasting there for a while, where we said, hey, deals are starting to come to us, clients are coming to us. We don't need to market as aggressively as we used to. We don't need to pound the phones quite as hard. We've kind of got this, and now we're seeing the results of that. We've ramped everything back up, and we're kind of back on track. But motivation for a lot of these companies, especially the young ones, is the biggest thing they have going for them, momentum and motivation. So when you slow that and you kind of start coasting, and again, that goes back to that work-life balance. Hey, things are going okay. We don't have to stay till 6 every day.
It's a little
now.
more lifestyle. Maybe need a
Again,
little
yeah.
more business.
Yeah, it's dialing that in every day.
Yeah.
So how do you make sure that when everything's ramp up and business is rocking, that you're not ignoring the business generation? How do you make sure you're doing both of those?
Sure. So it comes down to a balance of one, celebrating wins. So when you have your successes, going out and marking those. And I think I see a lot of companies that, they have a win, a transaction, a sale, what have you, and it's just immediately on to the next one. So I think taking time to at least recognize wins, big and small, is key, but also being cognizant to say, hey, this win isn't going to equal another win. We've got to get back in the weight room, so to speak. We've got to get back in our training and don't forget what made us successful. In other words, don't drift. And I see a lot of companies, ourselves included, that say, hey, this side of the company is just cruising along. We can go focus on something completely different. And you come back and it's a dumpster fire, 2 months later. And so keeping your eye on the road, making sure that you're doing what made you successful. Don't stop doing those things. You talk a lot about habits and things like that. And so habits within our business, I think, play a key role in remembering those habits that brought you where you are today, and not forgetting to do those.
Quick question for you, lightning round. If you could ask every next leveler a question, what would it be?
I think one of the greatest things that we've struggled with is that balance of getting the right people on the bus before you start driving it. So I think that the question would be, where did you find your best employees and how did you keep them? And that seems to be one of our greatest struggles is, one, finding these people. There's a million job boards out there. It's almost an overload of it. And some of our best employees come from people that we've met through friends. One of our guys we met at a gas station. And it's almost this by default that we're succeeding, and that's frustrating in a way, because with all the technology and the job postings and the internships out there, we should be able to have just a deluge of great employees through the door, and we keep finding them by accident. So I'd love to know from other entrepreneurs, how are you finding them and how are you keeping them once they're there?
What's next for you?
I think what's next is focusing a little more on the long term. The first 2 years, we're definitely got a nose to the grindstone. Make sure we make payroll. Make sure that they don't foreclose on
Important
anything.
Things, move out of Starbucks.
Move out of Starbucks. Start paying for full lattes, etc., instead of the medium and the small glass kind of thing. But then looking kind of further down the road, where do we want to be in 5 and 10 years? And again, that's a little cliche, but I think it's important because companies are kind of like ships, and they can take a long time to turn. And if they've gone the wrong direction for a year, that may be a big correction ahead. So kind of looking further down the road.
Well, Wolf, thanks so much for being our guest today. We've really enjoyed it.
Absolutely.
For our listeners, please go to peregrine1031.com to learn more. And if you want to know more about the show, go to nextlevelshow.com. And on the podcast, go to The Next Level Show.
Help spread the word.
See you next week.
Have a great week.
You have been listening to The Next Level, Conversations That Propel Business with Stephen Nooner and Bob Gibbons. Join us every Tuesday at 1:30 p.m. for more prolific conversations that will take your business to the next level.